Ladies and gentlemen, welcome again to Trade Africa. My name is Simon Ngon. Today, during this first part of market introduction, we will talk about some unusual term which some of you maybe are not familiar with. We'll also talk about the importance of the stock market in our society. Please stay tuned. Usually, when people hear about the Wall Street or the stock exchange, sometimes trading, they don't understand the meaning. And more important, they don't even know the impact of the stock market in our society. That is why we are going to start here by giving the trading or the stock exchange definition. Now, what is trading in simple terms? Trading is the action of buying and selling goods and services. It simply means buy or sell something for the intention to generate a profit during a fluctuation period. Taking that action qualifies you as a trader in general sense, like we typically call buy and sell in some parts of Africa. And the stock exchange is where the people call investors meet to buy and sell during fluctuation. That is why we call it market. But what are they selling or buying? They sell securities, bonds, stocks, and even commodities. Those can represent things like share of the company, gold, diamonds, oil, corns, even money. We will talk more about that in the future. And the Wall Street is used as an umbrella term to describe the financial market and the companies that trade publicly on the exchange throughout the US. But why is this so important for you and I to talk about it now? Because according to the statistic, the stock market is where most of the world money circulates. And it's also the place where richest people in the world invest around 30% of their capital. Knowing how valuable and important money is for our society, being interested in what's going on the stock market is a good idea. So, let's consider the fact. The statistics show that the total market capitalizations of all public traded security worldwide rose around $106 trillion at year 2022. And there are about 60 major stock exchanges in the world. You will ask me, what is market capitalization? The market capitalization is the value of the company that is traded on the stock market, calculated by multiplying the total number of shares by the current share price. We can also call it flow of the company. Usually, when the company goes public, they have several shares available for investors to trade. So, those shares or flow of the company represent the total value of that company multiplying by the value of each share at that moment. Let's take the example of Apple. As we are speaking, Apple share flow is around 16.1 billion shares, and its current share price being approximately $147. So we just need to multiply $147 by 16.1 billion share, and we will have the market capitalization, which is 2.35 trillion US dollars. It's a little bit tricky for some to understand, but we will get there, trust me. As January 2022, US is the largest stock market with 50% alone of the $106 trillion, followed by China, Japan, India, and UK. So if we compare the global market capitalization, which is around $106 trillion, to the world GDP, meaning gross domestic product, which is around 103 trillion US dollars, we can say that there is a lot of money circulating in the stock market than any other place on this planet. That is also the reason why, according to the Main Street investors, American households own $38 trillion worth of equities, more than 59% of the US equity market, either directly or indirectly through mutual fund, retirement account, and other investment. So it's important to stay close to the well fountain. If you are thirsty, you may drink a small part of the water. This means we need to stay close to the stock market by either trading or investing in order to get a small share of that money. But now, who needs the stock exchange? Company needs money to grow their business, but they have two options. They can raise money from their stockholder or borrow from the bank. The disadvantage in the bank loan is that, unfortunately, the loan must be repaid. Not only the initial sum be returned, but as we all know, the bank keep increasing interest along the way. In short, a company getting loan from a bank not only burdens itself with the payment of the initial loan, but also the added amounts of interest, all which slow down the company progress. Like you can borrow money to start the business with interest. That amount and the interest will slow your company down compared to someone who receives an inheritance. That is why people came up with a good idea, money that doesn't need to be returned or to pay back. It's called the IPO, initial public offering. But what is really an IPO and how does it work? That is what we will see in our next lesson. I invite you, especially those who are new to our channel, to subscribe and share our video. See you next week for the second part of our introduction. Thank you.